Welcome to the Week 6 video lecture of Accounting for Decision Making. I congratulate you for being in the final stretch of the course. You've been working really hard, pursuing efforts to successfully complete your assignments, doing your readings, and this is an exciting moment for you. You're almost going to make it out of accounting. So in Week 6, we're going to compare and contrast capital budgeting methods, and we're also going to prepare the statement of cash flows using the indirect method. But more than anything, your preparation of the statement of cash flow is mainly going to be an analysis of the actual statement and what it's used for and what are the outcomes of the statement of cash flows. Not so much you preparing, the actual statement, but actually what's going to really take place is me preparing you to be able to analyze it. So what is the importance of capital investments in the capital budgeting process? Well, capital budgeting is the process of making capital investment decisions. And those are very important because capital investment means acquiring a capital asset. And those are equipment, plants, buildings, land, information technology, a big plant, especially for a manufacturing company. And there are four methods of capital budgeting that you should know. One is the payback period, and that's how fast cash investment will be recouped. Short lifespan investments. The accounting rate of return is ARR, and it indicates profitability of investment. And it's also a short lifespan investment. So payback period and accounting rate of return both have a short lifespan investment. Then we're going to have the net present value, NPV. Factors in the NPV, better for longer lifespan. And the internal rate of return, the IRR, has factors in the net present value, and they're also better for longer lifespan. So payback period and the accounting rate of return have shorter lifespan investments. The net present value and the internal rate of return they both factor the NPV, and they're better for longer lifespans. Now, if you focus on cash flows, the capital budgeting focuses on cash flows. It is a desirability depending on the net cash inflows. And the cash inflows include future cash revenue from investment, future saving and ongoing cash operating costs, future residual value of the asset, and net cash inflows against cash outflows from investment. In the capital budgeting process, you're going to have several steps. One is to identify potential capital investments. The second step is going to be to estimate future net cash inflows. The third is going to be to analyze potential investments. Step 4 is to engage in capital rationing and choose among alternative investments. And step 5 is to perform post audits after making capital investments. So you have your 5 steps of the capital budgeting process. Sustainability, as it relates to capital investments, involves the location and transportation. So you look at the industry, and you look at the location and transportation. You look at sustainable sites. You focus on water efficiency, energy and atmosphere, materials and resources, indoor environmental quality, and you make sure that you pursue efforts to preserve and protect the environment. Now, how would you use the payback and accounting rate of return methods to make capital investment decisions? Well, the payback, you look at the payback period, the length of time to recover in net cash flows. It measures how quickly managers expect to recover investment dollars, and the shorter payback period is more attractive. So if we look at an example for an organization called Tierra Firma is considering a potential investment in an energy efficient HVAC system that is expected to cost $240,000. It has an estimated useful life of 6 years, no residual value, and equal net cash energy savings of $60,000. So if we look at the initial investment is $240,000, which the HVAC system is going to cost. So the payback period is a formula. The payback period is equal to the numerator and the denominator. The numerator is the investment period, and the denominator is the expected annual net cash inflow. All right, so the denominator is the annual net cash flow, which is 60,000, and the numerator is the investment, which is 240,000. So 240,000 divided by 60,000, it's 4 years is the payback period of the HVAC system. So again, to review, the payback period is the initial investment divided by the expected annual net cash inflow. Based on the information given in the case, your initial investment is 240,000 divided by the expected annual cash inflow is 60,000. It's a 4-year payback period. Now, we look at another example for Tierra Firma, another considering a potential investment in development of a business-to-business portal. It has an estimated useful life of 3 years, no residual value, and equal net cash savings of 80,000. So numerator divided by the denominator. Payback period is initial investment divided by the expected annual net cash inflow. You get the investment of 240,000 divided by 80,000, gives you a 3-year payback period. Now, if I give you if I elaborate on the payback with equal annual net cash inflows example, you're going to see that in year 1 you had 60,000. In year 2 you have another 60,000. So by year 2 you have 120,000. Year 3 you get another 60, that's 180,000. In year 4 you get another 60,000, that's 240. So that's, you can also look at it that way, 4 years at 60,000, 240. In the other example you got 80,000 at 3 years, is 240,000. So that's the payback with the equal annual net cash flows example. So comparing payback periods between investments, a business-to-business portal has a 3-year payback period and an HVAC system has a 4-year payback period. And then we're going to transition into focusing now on the statement of cash flows. And the statement of cash flows is the 4th financial statement that you prepare. And the statement of cash flows has 3 activities. It has activities from the operating aspect of the organization. So what are operating activities? Operating activities include revenues and expenses. And operating activities are important because you want to be able to analyze if the organization is generating revenues. And are the revenues significant enough to pay off the expenses? And if there's a net income, how much is being retained and so forth. The next one you have are investment activities, which is the sale or acquisition of plant assets. Cash, there will be a cash outflow when there is an acquisition of an asset. You buy land, you buy vehicles, you buy computer equipment, the cash goes out. Okay, you sell a building, the cash comes in. So cash inflows and outflows from investment activities. And then you have financing activities, which is the sale or acquisition of stocks and bonds. Now, cash can be generated through the issuance of stock because you acquire cash, and that's one of the benefits of a corporation over a sole proprietorship, that you're able to generate cash. And external users will look at the statement of cash flows because where external users are probably going to be concerned is if they see that a lot of the cash inflows are coming in from the sale of an asset in order for the company to stay afloat. You see, investors want to see a healthy operating activities, that sales are being made, sales are being generated. And it doesn't have to be in every period of the year or in every quarter of the year, because some businesses like department stores, they make all their they make 80% of their revenue like in November and December, department stores, because of the holiday season. So some businesses that are seasonal, you can't hold them accountable for them not generating as much revenue as they do in their, during the season. So investors will focus on that. They will focus where the cash inflows and outflows are coming from, because cash inflows from the issuance of stock is not necessarily a red flag, because that means that the company is attractive enough to recruit investors that want to support the organization in their short-term and long-term strategies. And as a result of their planning and their strategy and building good, reliable products, total quality services, they're gonna generate revenue. They're going to maintain their credibility in the industry. Their stock price is going to appreciate, and there's a lot of benefits to that to look at. So in the statement of cash flow, what is really important for you to know is what the three activities in the statement of cash flow are. Operating activities include revenues and expenses. Investment activities is the sale or acquisition of assets, which means that cash goes out if you purchase the asset, cash comes in if you sell the asset. And financing activity, cash comes in if you issue stock, cash goes out if you basically buy more stock. So we're gonna make sure now that you're ready for your assignments for week 6. And the first one, your first week discussion question, discuss the three activities in the statement of cash flows and explain what investors are looking for. Excellent, I think you have that one down packed. Discussion question number 2, out of the 4 popular methods of capital budgeting analysis, discuss 2 methods in which the payback period and accounting rate of return work well for capital investments that have a short lifespan. Excellent. Well, you have the foundation for this. We went over specifically those 2. Even though we went over 4, those 2 were covered. And lastly, your third discussion question is evaluate a firm's decision to use the indirect method over the direct method when preparing statement of cash flows. And most companies will use the indirect method of the statement of cash flow simply because most organizations opt for the accrual basis of accounting because of the matching principle and the revenue recognition principle that will use that. Also, their inventory methods, may play a role on that as well. So you're good with the discussion questions. And then, part 1 of your written assignment is the capital budgeting process. And what you're going to do is you're going to have a list of activities, and you're going to place the following activities in order from first to last to illustrate the capital budgeting process. So, in the capital budgeting process, from first to last, list them. So you're going to have activities like making investments, using feedback to reassess investments, identify potential capital investments, budget capital investments, and you're going to list them in order. Part 2, you're going to compare the capital budgeting method. So you're going to compare the ARR, which is the accounting rate of return, to the NPV, the net present value, or the internal rate of return. You're going to do that. And lastly, the statement of cash flows, you're going to evaluate and analyze the statement of cash flows for the most recent year. And you're going to do this for visiting a website. Okay, so you're going to visit a website for a publicly traded company such as Marriott Hotels, Hilton Hotels, Coca-Cola, Pepsi, or an organization of your choice. You got some liberty there. So obtain their financial statements from their investor relations site, and then you're going to evaluate and analyze the statement of cash flows for the most recent year. You'll prepare 1,200 word APA formatted deliverable where you discuss what took place as it relates to operating activities, financing activities, and investing activities. Elaborate on how statement of cash flows support the planning and budgeting endeavors of a company. Excellent. I definitely think that you're ready for that one too. Thank you for attending the week 6 video lecture, and good luck in week 6. Remember to ask me any questions in the classroom or email me. Thank you very much, and good luck.